Welcome to Market Newbie Trading Basics Series 2, Lesson number 9, Fundamental Analysis, Part 3. Following the last lecture on the discussion of fundamental analysis at the industry level, in this lecture we'll discuss fundamental analysis at the company level. When it comes to the study of a company's performance, there are a few things we need to consider. This includes but not limited to the following: its revenue, P/E, EPS, liquidity, business plan, and management. If we review these parameters, we'll be able to provide a better picture of how the company performs so that we'll be able to make a more educated decision as to whether buy or sell stocks from this company. Revenue generally means the income that a business has from its normal business activities, usually from the sale of goods and services to customers. Revenue is also referred to as turnover. Revenue may also refer to the business income in general, or it may refer to the amount earned during the period of time. For instance, it can be said as, last year, Company X had revenue of $50 million. Profit or net income generally imply a total revenue minus total expenses in that given period. So don't confuse revenue with profit. Size matters, but a bigger revenue doesn't necessarily mean a better company. Revenue just gives you the idea of how much money comes in and out of a company's bank account. Size probably gives you a better idea of how big a company you are dealing with. EPS stands for earning per share, which is simply the total net profit divided by the number of shares. Usually, what happens is analysts in the market provide EPS estimates before the quarterly earning reports and then compare the estimate with the actual data to see how the company meet the expectations. Based on this comparison, analysts can decide whether to sell or buy. In most cases, if the actual data is higher or better than the estimates, buy signal will be spread all over the market and share prices tend to rise. The P/E ratio is calculated as the stock's current share price divided by its earnings per share, that is EPS, for a 12-month period, usually the last 12 months. Typically, companies in very stable, mature industries that have more moderate growth potential have lower P/E ratios than companies in relatively young, quick-growing industries with robust future possibilities. Therefore, when an investor is comparing P/E ratios from two different companies as potential investments, it is important to compare companies from the same industry and with similar characteristics. It essentially tells us how much investors are willing to pay per $1 company profit over share. The higher P/E means there is more demand for that stock, while there is also more expectation in terms of growth. If the company doesn't make as much, investors lose interest and quickly sell. The P/E ratio must always be considered relative to the company's position in its life cycle and relative to its peers in the same industry, as well as to the market as a whole. For instance, newer companies with high growth prospects usually command very high P/E ratios since their current earning may be very small because they spend money to grow, but can grow or become quite profitable in the future. For similar reasons, in general, companies in the biotech and technology sectors have carried higher than average P/E ratios. In summary, always compare a company's P/E ratios with that of the industry it's categorized under. If it is significantly higher than the average, you need to find out why, and if there's no solid reason, then it usually means the company stock is overpriced. Same goes with lower than average P/Es. If P/E is low and there's no reason for that to be low, you can look into long-term investment in that particular stock. The next concept we want to discuss for analyzing at a company level is spread and liquidity. Before we introduce liquidity, we need to talk about two important prices, that is, sell price and buy price. Sell price is the price that's higher, and the buy price or the bid price is the one that's lower. The difference between the two is called spread. If the spread is too small, that is only a few cents only, we say that the stock is liquid. If the spread is big, liquidity is low. Buying selling at market price for low liquidity stocks is not recommended, since it means there is not a lot of demand for that stock. This means the company's stock is not easily sold in the market because there are not a lot of bidders in the stock market. Business plan is an important factor in analyzing the market at the company level. Business plan model or concept forms the foundation upon which all else is built. If the plan stinks, there is little hope for the business. You might think that it's difficult for the general public to figure out a business plan for a company, but you need to know that most reputable company business plan is researchable online. As a good example, you can easily figure out how Snapchat started the company and what revenue it had to attract subscribers and members. Big companies publish their general business model for which you can deduce growth based on your own judgment. The next concept or factor is management. In order to execute a business plan, a company requires top quality management. Investors might look at the management to assess their capabilities, strengths, and weaknesses. If the management is a problem, it is sometimes best to move on. Now, let's put everything that we learned in this lecture with the past two in fundamental analysis. You need to put the three-level analysis together in order to make a sound decision on what companies to pick. First, start with economy level and filter out the countries you are not interested in investing. Then, pick a few leading sectors or industries and draw a diversification map. Within the chosen industry, pick the companies you think are going to be overperforming and take it from there. After all of this, an investor will be left with a handful of companies that stand out from the pack. Over the course of analysis process, an understanding will develop of which companies stand out as potential leaders and innovators. In addition, other companies would be considered laggards and unpredictable. The final step of the fundamental analysis process is to synthesize all data, analyses, and understanding into actual picks. Fundamental analysis is good for long-term investments based on very long-term trends. The ability to identify and predict long-term economic, demographic, and technological or consumer trends can benefit patient investors who pick the right industry groups or companies. During the process of conducting the analysis, you will develop business skills and learn. However, there is a drawback, that is, time constraints. Fundamental analysis may offer excellent insights, but it can be extremely time-consuming. It also doesn't consider market emotions, which could be very well influential in price movements in the short term. This is why we conduct technical analysis, which will be explained in Market Newbie's intermediate module. Coming up next, we'll talk about dollar cost averaging. Thank you for watching this video, and I hope you enjoyed. To find more educational materials, visit www.marketnewbie.com, follow us on Facebook and Instagram, as well as subscribe to our channel on YouTube. See you in the next one.